Good morning. My name is Yuri Bender, Editor-in-Chief of Professional Wealth Management, the leading monthly title from the Financial Times stable for European distributors and private bankers. I'd like to welcome you all to the FT headquarters here in London. I'm delighted to be sitting amongst such eminent and knowledgeable personalities from the investment world, including at least 3 professors, I believe. I'm indeed honoured to be in such company. The aim of our roundtable discussion, sponsored by BNP Paribas Investment Partners, is to evaluate the opportunities in systematic investing for European private banks, fund selectors and other institutions. We plan to compare quantitative versus traditional investment models to discuss the creation of new ranges of investment products and how quant methodology can be incorporated within them, and then to determine whether today's climate is right for a return of the quants. As a side product, it would also be good if we could come up with a new quant-determined tactical formation for the English football team, though I fear that the 2 hours we have at our disposal would not be sufficient for such a mammoth task. And as we also have some American and Italian support within the room, I would not wish to encourage any deliberate sabotage. As today's impartial referee, I'm keen to encourage as open a debate as possible, so please feel free to interject, add your opinions wherever you think fit, as I'm sure there'll be questions which I may fail to bring up, which will be more obvious and pertinent to your expert eyes. Could we first go round the table, gentlemen, and introduce yourselves to our readers and web viewers in terms of job title, broad role, and the amount in assets you are responsible for, starting with Ben on the left.
I'm Ben Palmer. I'm Head of Portfolio Construction for Schroders Private Bank here in London. My role includes investment selection and also managing our core range of model portfolios to exhibit specific risk characteristics. Schroders Private Bank manages around £10 billion in assets on behalf of high net worth individuals, family offices and trusts and charities.
I'm Aiman Rasheed. I'm Chief Executive of Create Research, which is a UK-based think tank that specializes in global investment matters. We don't as such have assets under management, but we advise a number of pension plans and also asset managers on a number of areas of their business model, including asset allocation.
My name is Bob Hagen. I'm president of Hagen Custom Financial Systems. I'm also an advisor to Alfred Berg, an investment company in the Scandinavian countries. I was a professor of finance for 30 years. I held endowed chairs at the University of Wisconsin, University of Illinois, University of California. I've written 15 books on the stock market, which have been collectively published in 7 languages. Someone did a count recently of numbers of papers published in the top 7 finance journals, and I came out in the top 20, which I was happy to see.
Hello, I'm James Bevan, Chief Investment Officer at CCLA Investment Management. We are specialists in the management of funds for charities and trusts with around £5 billion under management. I am responsible for asset allocation, for the assessment of investment opportunities and for instrument selection.
I'm John Venturi. I'm the lead portfolio manager for Scandi Investment Group's multi-asset funds. My role is to pull together the asset allocation and selection research from our 40-strong investment team. We have about 10 billion sterling under management, and Scandi Investment Group advises on open architecture and guided architecture platforms with about 50 billion sterling on them.
My name is Matteo Campy. I'm head of quantitative management for AGI Investment Europe. We have several kind of products with different content in quantitative stuff, and we manage around 3.5 billion euros.
My name is Adam Wethered. I'm a co-founder of Lord North Street, a private investment office. If we were in the States, we'd be called a multi-family office. We act for a number of wealthy families and charities, We choose the asset allocation, we select managers, and we run discretionary multi-asset class portfolios.
Professor Helga, it's a pleasure to have you here at the FT, and our thanks for making the trip from the States. You're widely credited as being the man who cast a dark shadow over Eugene Fama's efficient market hypothesis, which stated that it was virtually impossible to consistently outperform the market by using any information the market already knows. But your discovery of a market abnormality in 1967 appeared to fall on deaf ears. Can you simply explain the minimum variance concept you discovered together with Jim Hines, and why you feel your discovery was ignored for at least 25 years and in some ways still flies in the face of conventional portfolio theory taught in US and European business schools?
I probably am, undoubtedly, am the oldest person here at this table. I was trained under what I would consider to be the old finance in the early 1960s. And we were trained to do things like understand the legal ramifications of bankruptcy, mergers, consolidations. The book I was trained on was a book called The Financial Policy of Corporations, written by a man named Arthur Stone Dewing. And we were trained under Graham and Dodd. We were trained to understand accounting numbers, standardize them across different kinds of companies, and value companies. When I got into graduate school, I began to hear rumors that something was stirring at the University of Chicago. And in fact, there was about to become a paradigm shift in the field of finance. Gene Fama, who was a graduate student around 1963, came up with the idea that perhaps markets are efficient in the sense that the price of every stock at all times reflected the true value of the company. This is an interesting idea, and it rendered obsolete everything I was trained to do, because if that were true, the market peered through the veil of accounting numbers, standardized everything already, and what we were doing was redundant. My professors became obsolete. They were slowly replaced by professors who were trained under the new paradigm of efficient markets. And eventually I went to the University of Wisconsin. I learned this new paradigm. I accepted it at first. But then over the years I began assessing the evidence, and the evidence appeared to me to be highly inconsistent. This started right away, actually, at the University of Illinois, where I got my PhD. And as you said, Yuri, I did a study with an economics professor named Jim Hines. And we looked at the performance of randomly constructed, equally weighted stock portfolios going back to 1926. And we found that in most periods, the lowest risk portfolios had the highest realized returns. And this seemed to be consistent all the way through the middle 1960s. Since then, I've done studies that follow up on this, and it continues to be true to this day. Low risk portfolios of stocks tend to produce higher returns. And in terms of why it's taken so long for people to come around to this, basically finance departments in business schools across the world are trained to theorize on the basis of rational economic behavior. And if they're confronted with evidence that that is totally inconsistent with the way markets perform, they become obsolete, just as my old professors became obsolete. It wasn't a pleasant experience for them. It's not going to be a pleasant experience for the for the professors of the paradigm of modern finance either, and they're going to resist this with all their might, and they're doing that.
So basically, this is the capital asset pricing model as well, which is turned upside down.